Okay, so it looks like it's just us, so why don't we get started? Welcome everybody to our October 2024 presentation of banking in Canada. So this is part of our Back to Basics series. So far this year, we have talked about insurance basics, investing basics, and now we're talking about banking. So while we're talking about banking in Canada here, we're just going to talk about using a bank account effectively in Canada, to understanding how banking works, what the different kinds of bank accounts are, what the different kinds of banks are, and different banking steps and practices. Here's a comprehensive guide on how to manage your bank account. So, choosing a bank account. When you're looking at where you want to bank in Canada, there are a couple of steps to figuring out what you should do and where you should go. So, selecting a bank. Choose a bank based on factors like fees, services, the location, and how they approach customer service. Identify your own needs. Determine what type of account you need. So, for example, do you need a checking account, a savings account? Are you a student? Are you opening an account for a child? All of these have different options associated with them. Gather your documentation. Typically, you'll need identification such as a passport, driver's license, proof of your address, and your social insurance number to open a bank account. When you're opening an account, you can open an account in person at a bank branch, or you can open certain kinds of accounts online, depending on the bank's offering. So when you're choosing a bank in Canada, you have a few different options. Opening a bank account is a straightforward process, but there are several key pieces of information and documentation you need to be aware of. Here's a step-by-step guide. So there are 3 different kinds of banks in Canada. There are major Canadian banks like RBC, TD, Scotiabank, BMO, and CIBC. These banks offer extensive branch networks and a wide range of services. Credit unions. Credit unions are actually member-owned financial institutions. They often have lower fees and more personalized service. And then there are online banks. Digital banks like Tangerine or Simply Financial, which used to be PC, offer competitive interest rates and lower fees due to their lack of physical branches. Once we're done, I will give you time for questions, but if you do have a question, feel free to ask during our presentation because there are just a few of us today. So what are the types of bank accounts? Oh, I need to get me out of here. So there are checking accounts. What's a checking account? A checking account is ideal for daily transactions such as paying bills, making purchases, and receiving deposits, like your paycheck. Number 2 is a savings account. A savings account is designed for saving money and earning interest over time. But make sure you know what the terms are, because although some bank accounts may be labeled savings accounts, you may not get any growth on your money while it's in there. Student accounts. Student accounts are generally designed for young people. Typically, they have no monthly fees and lower transaction costs. You often have to prove that you are going to an educational institution by sharing your student ID or showing your student card. Youth accounts. So, youth accounts are designed for young people, typically with no monthly fees and lower transaction costs as well. Both youth accounts and student accounts often offer special benefits. With youth accounts, you may need a parent to help you open the account if you're not over 18. Joint accounts is number 5. And a joint account is shared between 2 or more individuals. Try this way. between 2 or more individuals. It's suitable for couples or family members. And business accounts. Business banking is for managing business finances. There are features specific to business needs, and they may offer other benefits depending on the kind of business you have. So what is actually required for opening a bank account? There are 3 big things that you have to have. So you have to have some kind of photo identification. If you don't have photo identification, they will ask you to identify a different way. So examples of photo identification are a passport, driver's license, Canadian citizenship card, permanent residence card, health card, if it's allowed by your province, that depends per province, birth certificate, and social insurance card or document. For children born in the last few years, they are not actually issuing a social insurance card, and you have to order it through Service Canada if you want a card for it. The second thing you're going to need is proof of address. So documents like a utility bill, a rental agreement, or any official correspondence, for example, correspondence from the federal government or the provincial government, can be used as proof of address. The next one is your social insurance number. A social insurance number is normally required to open a bank account, but generally are required for bank accounts that earn interest to report the interest to Canada Revenue Agency. The next piece is, are you eligible? How do you know if you're eligible? So you must be 18 years old. Minors who are opening youth accounts, for example, may need a parent or guardian to co-sign on the account. And residency statuses. Most banks require you to be a resident of Canada, but some banks offer accounts for non-residents or newcomers. Most organizations that help newcomers acclimate to Canada will be up to date on where you can get that information. And once again, how do you open these bank accounts? So you can either go in person, and some banks may require you to be there in person. This will be to verify that you are you. And other banks may offer online account opening options. You'll need to upload or provide details of your identification documents. So managing your account. Every account in Canada pretty much offers online banking. You don't have to have online banking access, but as we creep forward in time, less and less banks want you coming through their doors to do regular banking. Accessing your bank account online allows you to check your balances, view transactions, pay bills, and transfer money either between accounts or to other people. Mobile banking. So what's the difference between mobile banking and online banking? One of them can be done either on a computer or through an app on a phone or tablet. But mobile banking is specifically through an app on your phone or your tablet. Most apps offer similar features to online banking, but they may not be as comprehensive. Your statements. Review your monthly bank statements to track your spending and ensure there are no unauthorized transactions. Often you can opt out of getting paper statements, but you will still have access to your statements through online banking. And alerts. So banks give you all kinds of alerts right now. You can set up alerts for things like low balances, large transactions charged to your account, due dates for bills, and other things to help manage your accounts. Other alerts you may get from your bank is if there has been a suspicious transaction. You may get a phone call, sometimes you'll get a text, but they will always ask you to contact them through the number that's on the back of your bank card. They will not call you and ask you for your information. So what do you do now? You've opened a bank account. What happens next? Some bank accounts would require an initial deposit. This initial deposit allows you to start interacting with your bank. The second thing they're going to ask you to do is activate your services. So they're going to ask you to set up your online banking and or your mobile banking. And they will often ask you to set up direct deposit for your salary or other incomes. One of the things we suggest you do is review your terms. So carefully read the account agreement and understand the terms and conditions. Most bank accounts that are through a major financial institution are not going to have any surprises, but do make sure you review what the fees and expectations are, especially if your bank has special options or special services with it, such as student accounts. By following these steps and considering your specific needs, you can choose the right bank and account type for your financial situation in Canada. If you have any uncertainties, visiting a branch and speaking with a banking representative can provide personalized guidance. If you're banking with an online-only bank, like Tangerine, Simply, or Motive Financial, calling their 800 number will ensure that you get to talk to somebody who's experienced and can answer your questions. So your account is open. Now what? You can set up direct deposit. You can deposit money physically at the bank. You can transfer money from other banks or other accounts. You can receive transfers from other people. And you can use your mobile banking app to deposit checks. This requires you to take a photo of the front and back of the check, and it will deposit it automatically to your account. Sometimes it feels like a whole new world. Withdrawing money. So how do you get your money out of there? You can use an ATM, which is an automated teller machine, where you use your debit card to withdraw cash. Beware of potential fees for using out-of-network ATMs. So an ATM that's out of your network is one that's not associated with your own bank, or is an ATM that you see at sporting events or other public places. They normally will disclose their fees on the main screen, but some can charge fees up to $7.50 per transaction. The second way is you can actually walk into the branch, walk up to a human being and withdraw money. The third way is you can get cash back when making purchases with your debit card at some retailers. The most common place you see this are places like Walmart and grocery stores. You can make a purchase and then add on a certain amount of money so that they'll give you cash back right at the till. The next one is making payments. So you can use your debit card for purchases at stores, online, or via mobile payment options like Apple Pay or Google Pay. These two options, Apple Pay or Google Pay, are using your phone where you have entered your debit card information to make payments instead of using the card itself. Online banking. You can pay bills directly through your bank's online banking portal or mobile app. And Interac e-transfers. You can send money electronically through the Interac network to other individuals using their email address or phone number. The last one is pre-authorized debits. You can set up automatic bill payments directly from your account to do things like pay your phone bill, your mortgage, your rent, or a recurring payment to a person. And finally, saving money. Savings accounts are supposed to be used to set money aside for future needs while they're earning interest. Over the last few years, we have seen interest rates on savings accounts go down to virtually nothing, especially at larger banking institutions. So it pays to shop around a little bit and see what rates you can get on regular savings. The next way you can save money is an automatic transfer. Set up an automatic transfer from your savings, from your checking account into a savings account to build your savings over time. You can also do this into your investments. And registered accounts. When you're saving money, you can also set up registered accounts at your bank. It's important to understand what services they're providing that are attached to your bank account before you make those choices. You can consider using a TFSA or RRSP for tax advantage savings and investments if you feel that your bank is the right home for that. Keeping your money safe. So we have done another webinar on online safety. Please feel free to go and check it out. But when we're talking specifically about your bank account, we want to talk about your PIN, which is your 4 or 6-digit number to access your account, and your passwords. Keep your PIN and online bank passwords secure. Avoid sharing them with others. Lots of people I know keep them written down on a pad of paper that they keep hidden somewhere. Because of course, if you save it on your electronic device and someone else gains access to it, not only will they have the password for your bank account, but many other passwords that they can use to wreak havoc on your life. Monitor your accounts. This one is really important. With the ease of using your debit card to pay with just a tap, often it's difficult to keep track of how much money you're spending. Regularly review your account activity to spot any unauthorized transactions quickly and report them to your bank. And the last one is just that, report fraud. Immediately report any suspicious activity or lost or stolen cards to your bank. Your bank is going to be pretty good about taking care of you. Your bank is insured either through provincial banking, regulations, which we see with credit unions, or with a federal insurance company, which we will see in later slides. Either way, once you report it to your bank, they can investigate and hopefully make you whole again. Understanding fees and charges. So, monthly fees. Many different accounts have monthly maintenance fees. Although there are some ways to waive these fees, often, especially the big banks, will offer to waive your monthly fees if you keep a certain balance in your account. That balance can be as low as $1,000 and can be as high as $10,000, depending on the kind of bank account you have. Transaction fees. Understand the limits on free transactions and the charges for exceeding them. Often with low-cost checking accounts, you have a limited number of transactions you can do per month. And then over that amount, you have to pay per transaction, which can get really pricey. ATM fees. We have talked about these already. Check to see if there's any fees when you're accessing ATMs outside your banking network. It's not just the ones that tell you what the cost is going to be on the screen. If you're going to a different bank's ATM, there may be a cost. And overdraft fees. An overdraft fee is a charge that the bank charges you for withdrawing more money than is in your bank account. If you have an overdraft on your account, you will be allowed to go into debt with the bank for a certain amount of money. Overdraft is often $500 to $2,500. And you either pay a one-time fee for every time you use it, or you pay a monthly fee to have that overdraft. So, what are some tips for effective bank account management? Budgeting. Use your account statements and banking tools to create and stick to a budget. Sorry, guys. Some banks allow you to have entire budgets built right into their banking apps. automate your finances, automate your bill payments, and automate your automatic savings to ensure you stay on track with your financial goals. Stay informed. Keep up to date with any changes to your bank's policies, fees, or services to avoid unexpected charges. By following these steps and best practices, you can effectively use and manage your bank account in Canada to meet your financial needs and goals. So something that I learned is that young people don't always know what some of these are. Most people know what a debit card is. This is the card that's associated with your bank account that allows you to access the money you have inside your bank account or bank accounts. They are used for making purchases and withdrawals. You will also use the number on your debit card to access your online banking, and often to access your mobile banking. You access your online banking to manage your account, pay bills, transfer funds, and more through the bank's website or mobile app. A checkbook, which I learned some young people have never seen. A checkbook is a physical piece of paper that someone can use to give someone else money. As people with young people in our life, I would definitely suggest that if you have an opportunity to teach a young person how to use a check, you should go ahead and do that, because nobody else is going to teach them how to do that. An e-transfer. So again, this is one that young people are more familiar with. An e-transfer is like an electronic check that you give to somebody else. You can transfer money directly from yourself to another person using either their email or their phone number. So let's look a little bit at debit cards and credit cards. In Canada, debit and credit cards are both common tools for managing finances and making purchases, but they function differently and have distinct features. Here's a comparison of the two. So, how does a debit card work? It directly accesses the money that's in your bank account. It's directly linked to your checking or savings account. And when you make purchases or withdraw cash, the money is immediately deducted from your account. You use a PIN, a personal identification number, to protect your account. But with the use of TAP, it's often harder to keep track of how much money you've spent. With a debit card, you can't borrow. So you can't borrow money from the bank. You're only using your own money. There's an immediate impact. The transactions are reflected on your bank account balance right away. Generally, there are no interest charges or Interac fees, but there may be fees for certain kinds of transactions, such as using an ATM that's outside your network, or drawing more money out of your account than you actually have in there, overdraft. In Canada, debit cards are widely accepted. They're accepted at retailers, at ATMs, and for online transactions. Interac is the primary network used in Canada for debit card transactions. And anybody who's traveled to the United States or Europe knows that our banking system has been almost a decade ahead of other places in terms of security and accessibility. So what are some of the pros of what are some of the pros of using your debit card? There are no interest charges. Since you're using your own money, you don't have to worry about paying interest on it after you've borrowed it. It helps control your spending. You can only spend what you have, which helps to avoid debt. And it updates immediately. Your account balance is updated immediately after a transaction, making it easier to keep track of your spending if you're using mobile banking. The cons: there is limited fraud protection. While there are some protections against fraud, it's generally less comprehensive compared to credit cards, which are normally completely insured. It also doesn't build your credit. So if you're trying to build credit to do things like convince someone to lend you money to buy a car or buy a house, This is not going to help. So next, let's talk about credit cards. A credit card is borrowed funds. It allows you to borrow money up to a certain limit, which is called your credit limit. Make purchases or withdrawals. You can also take cash advances on your credit card, but there is often an extra cost to that. There's monthly billing. You receive a monthly statement with details of your purchases, and you must pay at least the minimum amount due. Paying the full balance by the due date avoids interest charges. So what are some of the features of a credit card? You're given a credit limit based on your credit worthiness. So this is where we talk about building your credit. If you have done a good job of paying your bills on time and staying in good standing with the places that you owe money to, this helps build your credit. Paying your credit card on time will also help build your credit. Credit cards have an interest charge. The interest charge should be stated up front. Credit card interest normally ranges from 12% to 24.99%. If you do not pay the full balance by the due date, you incur interest charges on the remaining balance. Interest rates can be high, especially for cash advances. Rewards and benefits. Many credit cards have other rewards. So for example, you can accumulate cash back, where basically every time you make a purchase, you get a little bit of money towards paying your bill once a year. You can get points that you can use to make purchases. You can do travel miles that you can use for travel. Beyond that, they have purchase protection. Most credit cards are 100% insured. So if someone steals your credit card number, you're insured against having to pay that money back. They often have extended warranties, and with certain credit cards, it actually offers you travel insurance on any purchase that you make on that credit card. They're widely accepted and in Canada and both internationally. So you will have better luck using your credit card outside of Canada than you will using your debit card. As the Interac network grows, so does the ability to use your debit card internationally, but don't count on it. So what are some of the cons of using a credit card? Interest charges. If you carry a balance, you will continually pay interest until you have paid it all the way off. Interest charges can add up quickly, and if you don't pay your credit card down consistently, you can pay thousands in extra interest. Debt risk. It's easier to overspend and accumulate debt, especially if you only make minimum payments. Fees. Some credit cards may come with annual fees, foreign transaction fees, late payment fees, and cash advance fees. So take a look at and understand the terms of your credit card before you use it. Understanding these differences can help you choose the right card for your needs and use them effectively to manage your finances. Many Canadians use both types of cards for different purposes. Debit cards for everyday purchases and budgeting, and credit cards for building credit and earning rewards. One of the things that we haven't talked about, though, is a secured credit card. Secured credit card kind of straddles a debit card and a credit card. So a secured credit card, you have put down a deposit to borrow against. So you're actually using your own money. A secured card is a great way to use your own money to travel without actually putting your bank account at risk. It also will help you build your credit. And as you grow in your credit building, you can apply for different credit cards that don't require security. One of the slides that we didn't talk about here, that I did talk about in my last webinar, is what the difference between and I'm just going to go back here. What's the difference between a big bank and a credit union? So we talked about this a little bit last time, but I think one of the things to note is that because credit unions are owned by their own account holders, you often find that you get more personalized service and better information at a credit union from their staff. The big difference between credit unions and banks is often how many services they offer. Beyond that, if you're looking at an online bank, you can be looking at a Tangerine or Simply. There are also online banks that are simpler, not simply, but simpler, that don't offer every feature of a full service bank. So some online banks don't offer business banking, and some online banks don't offer investments. Making sure that you pick the right bank for you will allow you to have the best banking experience possible. So with that, I'm going to go to the last slide and ask if there are any questions. No questions?
I don't have any.
Well, give me 1 second. Okay, try again. Any questions? Oh, I can hear someone. No? Okay, if you do have questions, you're welcome to reach out. With that, we conclude our basics of banking webinar. Thank you very much for your time tonight and your attention. Sorry for the little interruptions, but as you know, if you're in my office in the evening, we'll often end up with cleaners trying to interrupt us to clean the office. So have a great night and take care.
Thank you.
Thank you.